$5,000. That's the number that separates most people from the real possibility of building $1 million over the course of a lifetime. I'm not talking about theory. I'm not talking about hope. I'm talking pure, documented, verifiable mathematics that anyone with access to a $10 calculator can confirm in less than 3 minutes. And the most disturbing part of this equation is that it has existed for decades. It is available to anyone who cares to study it, and yet approximately 78% of Americans reach retirement age without enough assets to maintain their standard of living for more than a dozen years. This is not an income problem. It's not a problem of opportunity. It's a problem of mathematical understanding. And today, I'm going to solve this problem for you once and for all. James Simons, the mathematician who founded Renaissance Technologies and built the most profitable investment fund in the history of global financial markets, once said in a rare interview that the difference between people who build wealth and people who just dream about it is not the amount of money they start with, but a deep understanding of how money behaves over time. Simons didn't start out rich. He started out as a math professor at a university, earning a modest salary, with no Wall Street connections, no family heritage, no structural advantage other than a mind trained to see patterns where others saw only noise. And it was exactly this ability to see mathematical patterns that allowed him to build a personal net worth estimated at more than $23 billion before his death in 2024. But here's what most people don't understand about Simons' story, and about the story of anyone who has built significant wealth from modest means. The secret isn't figuring out which stock is going to go up tomorrow. The secret lies in understanding a mathematical equation so simple it seems almost insulting when you first see it, but so powerful that Albert Einstein reportedly called it the eighth wonder of the world. This equation has a technical name that you've probably heard, but perhaps never really understood in all its depth: compound interest. Now, I know what you're thinking. Compound interest. This is basic. I already know that. Everyone talks about compound interest. But let me ask you a direct question. If you really understood compound interest, why aren't you already on the guaranteed mathematical path to your first million? The answer is that most people know the concept of compound interest in the same way they know the concept of physical exercise. They know it's important. They know it works. But they don't apply it with the consistency necessary to reap the results. And the difference between knowing something and applying something is the difference between watching life go by and building the future you want. I'm going to show you now, with specific verifiable numbers, exactly how $5,000 turns into $1 million. And most importantly, I will show you why this process is mathematically inevitable when you understand the correct variables and apply them with systematic discipline. I'm not promising you'll get rich tomorrow. I'm promising that by the end of this analysis, you will understand exactly the mathematical map that connects where you are today to where you want to be in the future. What you do with this map is your decision. Before we dive into the numbers, I need to establish something fundamental. Are you the type of person who makes decisions based on data or based on feelings? Because if you're the data type, you need to be subscribed to this channel right now. Everything I share here is backed by research from institutions like the Federal Reserve, the National Bureau of Economic Research, Vanguard, the Journal of Finance, and dozens of other verifiable academic and government sources. Hit the subscribe button. Activate the bell. You'll want to be here in the next few weeks, because what I'm going to reveal today is just the beginning of a series of analyses that could completely transform your relationship with money. Now, let's get to the numbers. And when I say numbers, I mean real specific numbers that you can check on any free financial calculator available on the internet. Scenario 1. You have $5,000 today. Invest this amount in an index fund that replicates the S&P 500. It doesn't add another cent. Let that money grow for 40 years at an average rate of return of 10% per year, which is roughly the historical average of the S&P since 1926, as documented by Wharton School professor Jeremy Siegel in his seminal book on long-term market returns of shares. At the end of 40 years, your $5,000 would have turned into approximately $226,000. This is multiplying your money by more than 45 times without doing absolutely anything other than waiting. But wait, 226,000 is not a million. Correct. And this is exactly where most people stop paying attention, because they don't understand the second variable in the equation: regular contributions. See what happens when we add modest monthly contributions to the picture. Scenario 2. You start with the same $5,000, but now it adds $200 a month to your investment. $200 a month. That's less than many people spend on video streaming, food delivery, and coffee bought outside the home combined. Same rate of return of 10% per year. Same period of 40 years. In the end, you would have approximately $1,270,000. You read that right. $1,270,000, starting from $5,000 initially and $200 monthly. Now, let me break down this math so you can understand exactly where this number comes from. Because when you understand the origin of numbers, they stop being abstractions and become tangible reality. For 40 years of contributing $200 a month, you will have manually deposited a total of $96,000. Add the initial $5,000, and you have $101,000 of personal contribution over 4 decades. $101,000 coming out of your pocket. And the end result is $1,270,000. The difference, $1,169,000, is money you never deposited. It is money that money itself generated. It is the work of compound interest operating silently, 24 hours a day, 7 days a week, 365 days a year, for 4 consecutive decades. This is the magic that James Simons understood more deeply than almost any other human being in history. Simons didn't get rich because he was smarter than everyone else. He became rich because he understood that time is the most powerful multiplier that exists in the financial universe, and he structured his entire life and his entire investment strategy to maximize the time his money had to work. But here's where the analysis gets really interesting, and where most people make the most expensive mistake of their financial lives. Behavioral research conducted by Richard Thaler, winner of the Nobel Prize for Economics in 2017, documents a phenomenon called hyperbolic discounting. In simple terms, human beings are biologically programmed to prefer immediate rewards over future rewards, even when the future rewards are mathematically far superior. Our brains evolved on the African savanna, where survival depended on immediate gratification. Food available now was more valuable than food promised a month from now, because in a month you could be dead. This mental program was extremely useful for surviving in hostile environments 100,000 years ago. But it is absolutely disastrous for building wealth in the 21st century. What Thaler has demonstrated in decades of research is that the average investor systematically underestimates the value of future money and overestimates the value of present money. This leads to behaviors such as spending today what should be invested, withdrawing investments prematurely when the market falls, and delaying the start of investment programs for years or decades. And each of these behaviors has a calculable mathematical cost. Let me show you the exact cost of postponing. If you start investing $200 a month at the age of 25 and maintain it until you are 65, with a rate of return of 10% per year, you will have approximately $1,162,000 by the age of 65. Now, if you delay starting for just 10 years and start at 35 instead of 25, maintaining exactly the same monthly contribution and the same rate of return, you will have approximately $411,000 at age 65. Reread these numbers. The difference between starting at 25 and starting at 35 is $751,000, more than $750,000, for the crime of waiting 10 years. And the most disturbing thing is that in both scenarios you deposited exactly the same monthly amount. The only difference was the time the money had to work. James Simons understood this viscerally, and that's why he started applying mathematical principles to financial markets the moment he had the resources to do so. Not when he felt ready, not when conditions seemed perfect, not when he had all the answers. He gets her because he knew the cost of waiting was mathematically unacceptable. Now, one could argue, but 10% per year is an optimistic rate. The market doesn't always deliver 10%, and that person would be partially correct. The market doesn't deliver 10% every year. Some years it delivers 25%. Other years it loses 15%. Volatility is real. But here's what historical data documented by the University of Chicago's Center for Research and Security. Prices demonstrates unequivocally, in any 30-year period in the history of the American stock market since 1926, the average annualized return has never been below 8%. Never. These include the Great Depression, World War II, the oil crisis of the 70s, the crash of '87, the Internet bubble of 2000, the financial crisis of 2008, and the pandemic of 2020. What does this mean in practical terms? It means that if you have an investment horizon of 30 years or more, the historical probability of achieving average annualized returns between 8 and 12% is extremely high. Not guaranteed. Nothing in markets is guaranteed, but historically consistent to the point where it is a reasonable basis for long-term financial planning. Let's recalculate with a more conservative rate to satisfy the skeptics. Same initial $5,000, same $200 a month, but now using a rate of return of 8% per year instead of 10. Same period of 40 years. The result? Approximately $698,000. It's not $1 million yet, but it's much closer to what most people think is possible with such modest contributions. What if you want to get exactly $1 million at 8% a year? The math is simple. You would need to contribute approximately $290 per month instead of $200. Less than $300 a month? Less than the payment for many used cars? Less than the rent for a room in many American cities? Less than many people spend on entertainment monthly? Quick social experiment. I want to test whether people who think mathematically about money focus on specific regions. Put your city in the comments below. It could be Miami, Houston, Los Angeles, Chicago, Denver, Phoenix, New York, Austin, Bogota, Mexico City, Buenos Aires, Santiago, São Paulo, wherever you're watching. I'm genuinely curious about the geographic distribution of those interested in rigorous financial analysis. And while you comment, I'll continue breaking down the numbers because we still have a lot of ground to cover. Now let's talk about something that most finance channels avoid, because it's less sexy than get-rich-quick promises: the role of the investment vehicle in the equation. When I say you should invest in an index fund that replicates the S&P 500, I'm not giving a specific product recommendation. I'm pointing to an investment category that has specific mathematical characteristics that favor the long-term investor. First, low costs. A typical index fund charges a management fee between 0.03% and 0.2% per year. Compare that to actively managed funds that often charge 1% or more. This difference seems small in 1 year, but over 40 years, as documented in extensive Vanguard research published in 2019, the cost difference can represent more than 20% of the final equity. 20%. On a $1 million portfolio, that's $200,000 you've lost to fees over time. James Simons charged huge fees at the Medallion Fund. 5% management plus 44% performance. But it delivered average returns of 66% a year before fees, so investors still came out very positive. The point is, fees only make sense when they are more than offset by superior returns. And Morningstar research, updated annually, consistently shows that approximately 85% of actively managed funds fail to outperform their benchmarks over periods of 15 years or more. This means that paying higher fees for active management is, in most cases, paying more to receive less. Second, automatic diversification. When you buy an S&P 500 index fund, you are automatically buying a fraction of the largest American companies. Apple, Microsoft, Amazon, Google, Johnson & Johnson, J.P. Morgan, Visa, Procter & Gamble, all in a single investment. This diversification protects you from the risk of any individual company liable to go bankrupt or have serious problems. This is what academics call the elimination of unsystematic risk. Third, tax efficiency. Index funds tend to have low asset turnover, which means fewer taxable events over time. In taxable accounts, this can represent significant savings compared to strategies that buy and sell frequently. Simons deeply understood these principles, even if he himself operated on a completely different level with the Medallion Fund. He knew that for the average investor, the optimal strategy was radically different from the optimal strategy for a quantitative fund with hundreds of math and physics PhDs developing proprietary algorithms. And it is exactly this intellectual honesty that separates serious financial analysis from charlatanism. Now, I'm going to directly address the most common objection I get when I present these numbers. But I don't have $200 left over a month. I can barely pay my bills. First, I recognize that this is a reality for many people. There are genuine situations of scarcity where all income is necessary for basic survival. I'm not minimizing these situations. But I also know, based on Bureau of Labor Statistics research on American consumption patterns, that the average American family spends approximately $3,000 a year on entertainment, $2,500 a year on dining out, and more than $1,000 a year on streaming services and various subscriptions. This totals approximately $6,500 annually, or about $540 monthly, in spending categories that are technically discretionary. I'm not suggesting that you eliminate all entertainment from your life. This would be unsustainable and counterproductive. I'm suggesting that there is, for most people, room to reallocate $200 a month from present consumption to future investment. The question is not whether the money exists. The question is what your priorities are. Daniel Kahneman, the psychologist who won the Nobel Prize for Economics in 2002, demonstrated in his research that human beings are notoriously bad at evaluating trade-offs between present and future. We prefer the $5 coffee today to the additional $23,000 that coffee could become in 40 years. It seems like an absurd comparison when put in these terms, but it is exactly the comparison we are unconsciously making every time we choose immediate consumption over investment. Simons was famous for his personal frugality despite his immense wealth. He understood that every dollar spent was a dollar that couldn't work for him. This does not mean that he lived miserably. Far from it. It means he was conscious about his spending in a way that most people aren't. Let's look at another calculation that illustrates the power of small adjustments. Imagine you reduce your discretionary spending by just $50 a month. It's not a radical change. Maybe it's canceling a subscription you don't use, cooking more meals at home, or being more conscious about impulse purchases. $50 a month invested at 10% a year for 40 years becomes approximately $264,000. $250,000 of adjustments that you probably wouldn't even feel on a daily basis. Now multiply that. $100 a month. $528,000. $200 a month. $1,056,000. $300 a month. $1,584,000. The relationship is linear in contributions, but exponential in the final result because of the effect of compound interest. And here comes a crucial distinction that separates successful investors from frustrated investors. The difference between a focus on prediction and a focus on process. The average investor spends a disproportionate amount of energy trying to predict which stock will rise, when the market will fall, which sector will perform best in the next quarter. Philip Tetlock, a professor at the University of Pennsylvania, has spent 20 years studying the accuracy of predictions from experts in a variety of fields, including finance. His conclusion, published in the book Super Forecasting, was devastating. Most market forecasters are no more accurate than a chimpanzee throwing darts at a list of options. James Simons, paradoxically, also did not try to predict the market in the traditional sense. The Medallion Fund did not operate based on predictions of where the economy was going or which companies would succeed. It operated based on the identification of very short-term statistical patterns that were repeated frequently enough to be explored mathematically. It was a completely different approach, and one that is not available to the invested R individual without access to multi-million-dollar computing infrastructure and teams of PhDs. What is available to the individual investor is something equally powerful, if less glamorous: systematic consistency. Research by Dalbar, a company that has studied investor behavior for over 30 years, annually documents what they call the investor behavior gap, the difference between the return that the market delivers and the return that the average investor actually captures. Over the past 30 years, while the S&P 500 has delivered approximately 10.2% per year, the average stock fund investor has only captured approximately 7.5% per year. That difference of 2.7% per year, when compounded over decades, represents hundreds of thousands of dollars in lost wealth. Why does this difference exist? Because individual investors buy when the market is up and sell when the market is down. They do exactly the opposite of what mathematical logic suggests. They buy high and sell low, driven by emotions, euphoria at highs, panic at lows, instead of following a systematic process of regular contributions regardless of market conditions. This is the most important behavioral contrast you need to internalize. The emotional investor reacts to the market. The systematic investor ignores the market in the short term and focuses on the long-term process. The emotional investor sees a 20% drop and sells everything for fear of losing more. The systematic investor sees a 20% drop and continues his monthly contributions as normal, knowing that he is purchasing assets at lower prices. The emotional investor tries to be smart. The systematic investor accepts being disciplined. Simons was obsessive about systems. The Medallion Fund operated with strict mathematical rules that removed human emotion from the decision process. When the algorithm said buy, they bought. When it said sell, they sold. There was no room for feelings, for intuitions, for I think. It was pure mathematics executed with absolute discipline. You don't need sophisticated algorithms to apply this principle. You need a simple system: automatic monthly contribution, allocation to a diversified index fund, annual rebalancing if necessary, and completely ignore the daily market noise. Is it boring? Absolutely. Does it work? Mathematically, yes. Let's now talk about something that very few finance channels address honestly: the tax-efficient vehicles available to investors in the United States. If you live in the U.S. and aren't maxing out your contributions to a 401k with employer match, you're literally leaving free money on the table. Many employers offer a matching contribution of 3 to 6% of salary. That's an instant 50 to 100% return on your contribution even before any market returns. There is no investment on the planet that offers a comparable guaranteed return. In addition to the 401k, there are IRA accounts, traditional and Roth. A traditional IRA allows contributions to be deducted from current income taxes, while a Roth IRA allows tax-free growth and withdrawals in retirement. Depending on your specific tax situation, one may be more advantageous than the other. The annual contribution limit for IRAs in 2025 is $7,000 for people under 50 and $8,000 for people 50 and over. The math of tax efficiency is often underestimated. Let's calculate a specific example. Imagine you invest $6,000 a year for 30 years in a taxable account versus a Roth IRA account, assuming 8% annual return and a 22% marginal tax rate on capital gains and dividends. In the taxable account, you would pay taxes on dividends annually and on capital gains when you sell, reducing your effective return. In a Roth IRA, all growth is tax-free. At the end of 30 years, the difference between the two scenarios could easily exceed $150,000 in favor of the Roth IRA. Simons was meticulous about tax efficiency. Renaissance technologies used sophisticated legal structures to minimize tax burden on medallion fund returns. You don't need expensive lawyers to apply simplified versions of the same principle. Just use the tax tools the U.S. government makes available to all citizens and residents. Now let's directly address the elephant in the room: risk. When I talk about investing in index funds and waiting 40 years, someone invariably asks, but what if the market crashes and doesn't recover? What if I need the money sooner? What if something catastrophic happens? And these are legitimate questions that deserve serious answers. First, about permanent market collapse. For the American stock market to permanently collapse and never recover would require a scenario where the 500 largest American companies, and by extension the entire American economy, cease to functionally exist. This would imply civilizational collapse of a magnitude that would render investment portfolio concerns irrelevant. In a real apocalypse scenario, your 401k would be the least of your worries. That said, severe temporary declines are not only possible but historically recurring. The S&P 500 fell approximately 50% during the crisis of 2008. It dropped approximately 34% at the start of the pandemic in 2020. It fell more than 40% during the internet bubble in 2002. In each of these cases, investors who sold in panic crystallized their losses. Investors who maintained their positions and continued contributing not only recovered their losses, but ended up significantly in the positive. The point is not that falls don't matter. The point is that drops are temporary for those who have a long-term horizon and the discipline not to sell at the worst possible moment. Simons and his team at the Medallion Fund have experienced numerous periods of extreme volatility over 3 decades. What set them apart was an unshakable confidence in their mathematical methodology and an iron discipline in following the process regardless of market conditions. You can cultivate the same discipline with an infinitely simpler strategy. Second, about needing the money first. This is why financial planners recommend keeping a separate emergency fund, typically 3 to 6 months of expenses, in liquid, low-risk investments before you start investing for the long term. If you need to cash out your 401k in your 40s because you don't have an emergency fund, you'll likely cash out at a bad time in the market and still pay significant penalties and taxes. The solution is not to avoid investing. The solution is to invest in a structured way that allows you to deal with emergencies without compromising long-term objectives. I will now introduce a concept that Simons deeply understood and that most investors completely ignore. Earnings variance. When I say that the historical average return of the S&P 500 is approximately 10% per year, I am talking about a long-term average, but the average hides enormous variability from year to year. In 2019, the S&P returned approximately 31%. In 2008, it lost approximately 38%. The average is 10%, but almost no individual year delivers exactly 10%. What does this mean in practice? It means that two investors who start at the same time with the same strategy, but stop at different times, can have dramatically different results due to pure luck of timing. An investor who retired in March 2009 at the post-crisis market bottom would have a much smaller portfolio than an identical investor who retired in December 2007 before the crisis. How to mitigate this timing risk? With something called a glide path or gradual allocation transition. As you get closer to your goal, whether it's retirement, buying a home, or any other goal, you gradually move part of your portfolio from more volatile assets like stocks to more stable assets like fixed income bonds. This reduces your exposure to severe downturns at exactly the time you would need the money most. Target date funds do this automatically. If you plan to retire in 2050, you can invest in a 2050 target date fund that automatically adjusts the allocation over time, starting more aggressive when you are far from the target date and becoming more conservative as the date approaches. Simons would probably find target date funds too boring for his taste. But he would also recognize that for the individual investor, without the time or inclination for active portfolio management, they are mathematically elegant tools that solve a real problem in an automated way. Let me tell you a story that illustrates the difference between theory and practice in the world of investments. In 2008, during the height of the financial crisis, Fidelity Investments conducted an internal analysis to identify which of its clients had the best investment returns over decades. They expected to find patterns of superior market timing or brilliant stock selection. What they found was completely different. The customers with the best returns were those who had forgotten they had Fidelity accounts. Literally, people who opened accounts decades ago, set up automatic contributions, and then completely forgot those accounts existed. They didn't sell in the panic of 2008 because they didn't know they had investments to sell. They didn't buy at the top of 2007 because they weren't paying attention to the market. This story is often cited as a humorous anecdote, but it contains a profound truth about investor behavior. The best returns often come from doing less, not more. To be disciplined, not smart. To have a system, not intuition. Warren Buffett, another name often associated with extraordinary returns, famously said that his preferred investment period is forever. He buys companies he intends to hold indefinitely, not assets he intends to sell when they rise. This philosophy is diametrically opposed to the trader who buys and sells daily, trying to capture short-term movements. Interestingly, Simons and Buffett had seemingly opposite philosophies. Simons traded at very high frequency using algorithms. Buffett virtually never sells his positions. But both shared something fundamental: absolute discipline in their process, regardless of market conditions, opinions of others, or external pressures. Consistency, not specific strategy, was the common denominator. Now I'm going to do something that few do. I'm going to quantify exactly the cost of not starting today. If you are reading this at 30 years old and decide to wait until you are 35 to start investing $200 a month, assuming a 10% return per year until you are 65, you will have approximately $632,000 at 65. If you start today, At 30, you will have approximately $1,124,000. The difference of 5 years of delay cost $492,000. Divide that by 60 months of delay. Each month you delay costs approximately $8,200 in lost future wealth. Every month. Reread that number. Internalize it. The next time you think, I need to organize my finances first, or I'm going to start next year, or when I'm more stable, remember, each month of delay costs approximately $8,000. Simon started early. It started out imperfect. He started without having all the answers. It started, and then refined, adjusted, improved over decades. But the starting point was the decision to start. There is a concept in mathematics called initial conditions. In dynamic systems, small differences in initial conditions can lead to dramatically different results over time. This is the famous butterfly effect. In personal finance, your initial conditions are how much you start investing, when you start, and what you invest in. Optimizing these three variables has an exponentially greater impact than trying to optimize tactical decisions along the way. Let's now talk about something almost no one mentions when discussing the journey to $1 million: the psychological component of long-term consistency. Investing $200 a month for 40 years seems simple in theory. In practice, it is extraordinarily difficult to maintain any behavior for 40 years. You will go through periods of unemployment, personal crises, career changes, marriages, divorces, births, deaths, moving cities, moving countries. Life happens. And every time life happens, there is the temptation to pause, cash out, relocate, or simply forget. University of Pennsylvania psychology professor Angela Duckworth's research on grit, perseverance, and passion for long-term goals demonstrates that the ability to maintain consistent behaviors over time is more predictive of success than intelligence, natural talent, or starting circumstances. In other words, the averagely talented person who persists consistently outperforms the extraordinarily talented person who fluctuates. Simons built systems to remove the need for individual willpower. The Medallion Fund operated automatically, following algorithms that did not need human motivation to function. You can do the same by setting up automatic contributions that leave your account before you even see the money. If money never enters your checking account, you never feel the temptation to spend it. It is behavioral engineering applied to personal finance. If the mathematical framework I've demonstrated so far makes logical sense to you, hit the like button now. Only about 3% of YouTube viewers actually like the videos they watch. Be part of that 3%. And if someone you know is making financial decisions based on intuition rather than data, share this video with that person. It may be the most important analysis she watches this year. Now I'm going to address some advanced objections I hear from people with more financial knowledge. Objection 1. What about inflation? If average inflation is 3% per year, my real return is not 10%, it is 7%. Correct. Inflation erodes purchasing power over time. $1 million in 40 years will not buy the same as $1 million today. Using an average historical inflation rate of approximately 3%, $1 million in 40 years will have purchasing power equivalent to approximately $307,000 today. Does this change the fundamental conclusion? No. Because the alternative, not investing, is even worse. Money sitting in a checking account or under the mattress loses purchasing power to inflation without earning any compensatory return. Investing does not eliminate the problem of inflation. Partially mitigates it through returns that historically exceed inflation. Furthermore, if you want $1 million in current purchasing power 40 years from now, simply adjust your contributions upward or assume a longer horizon. Mathematics adapts. The principle remains. Objection 2. What if I die before using the money? This is a valid question that enters the territory of estate planning and life philosophy. The short answer is, if you die rich, you have options. Leave it to family. Donate to causes you support. Fund scholarships, whatever. If you die poor, after having spent everything, you leave no one options, including yourself in the final years of your life, when you would probably need resources most. That said, there is a balance to be found between saving for the future and living in the present. The objective is not to accumulate wealth for the sake of it, but to have financial security that allows you to live well both today and in the future. Finding this balance